Many business owners and entrepreneurs are deciding between an LLC and an S-Corp, and they read many different things online and may have some questions. So let's break that down in more detail here. To start, an LLC and an S-Corp are both actually an LLC. It's just that they are taxed differently. So an LLC is taxed as a sole proprietor, whereas an S-Corp is taxed as an S corporation. So the similarities would be is that for the business, after the revenue, expenses, that income does pass through to their individual tax return. There's liability protection for both in case you get sued or the business gets sued, and they can both take the qualified business income deduction. The difference lies in that there's no self-employment tax on a portion of the S Corp's profit, and the S Corp is going to take a salary as the owner. So how can the S Corp save you money? If you remember, if you ever had a W-2 job, you had self-employment taxes. So there's the Social Security portion and the Medicare portion, and your employer would pay half of this, and the other half would come out of your paycheck. Well, while being self-employed, you actually have to pay the entire full 15.3%. And so an S Corp can help save you a portion of this. So let's look at a couple examples. For an LLC, after the revenue, the expenses, other deductions, you're going to get the net income. And for this example, we use $100,000. And so after the self-employment tax that you would pay, you would be stuck with a $15,300 bill for the year. So for an S Corp, you're going to get paid, like I mentioned, in two parts, the distributions to yourself and the salary that you're going to pay yourself. So for the distributions, this is not going to have the 15.3% come out. And you can pay yourself the distribution quarterly or annually. It's going to be up to you. And then for the salary, it is going to have the self-employment tax. And so people have to make the decision, okay, so what do I have to pay myself as a salary if this is the only portion that's getting taxed this way? And the IRS stipulates that it must be a reasonable salary. So what's reasonable? A good way to look at it is what would you pay someone to do your job in your company? For our example, we're going to use the 60-40 split just to be lenient. So 60% salary, 40% distribution. So if we go back to the example and look at $100,000 net income again, 60,000 as a salary, 40,000 as a distribution. Only the salary is going to have that self-employment tax, and for the year you're going to have a $9,180 bill instead. So this is over $6,000 in savings just by making the switch to being taxed as an S corporation. And you would still have your state and federal taxes after that, of course. So what's the catch? Why are more people not doing the S corp? There are some small things to consider, such as payroll costs. Now that you're paying yourself a salary, you're going to have to set that up. You need to be IRS compliant. We already mentioned the reasonable salary. And you're going to have a more complex tax return for an S corporation. And there's strict rules for ownership, such as you have to be a U.S. citizen and you can't have more than 100 shareholders. When you look at this from a macro perspective, you're going to save over $500 a month just by making this switch. And there's an added benefit of now that you have a W-2 for the salary portion that you're taking, it's going to look better on loan and mortgage applications. Many times business owners can struggle to prove to banks that they're making a good salary. This could help with that. If you wanted to make this change, the deadline is March 15th of every year, or else you would have to wait till the following year to make the change to be an S Corp. If this is the kind of thing that you're looking to do and need help or have questions, please email us here at bcking06@gmail.com.